This is Agriculture Today, and I'm Samantha Bennett with the K-State Radio Network. Roger McEowen joins us to start today's show with an agricultural law update. He shares insight on cases where failure to pay taxes on property and with the government selling and keeping the profits of the entire equity of the property. And the current case from Minnesota set before the U.S. Supreme Court. We also discuss ethanol outlooks for 2023 with K-State grain economist Dan O'Brien. Dan emphasizes the importance of a stable U.S. economy and our nation's ability to travel this summer when it comes to supporting this vital industry in the Midwest. Today's show is rounded out with this week's Beef Cattle Institute's Ask the Experts. Our K-State experts this week include Brad White, Dustin Pendell, and Bob Larson. And they end today's show by answering a listener's question on whether or not it's a good idea to lock in prices for calves now that they plan to sell in the fall. That and more is coming up ahead on Agriculture Today. This is Agriculture Today. We are joined now by K-State and Washburn University School of Law professor Roger McEowen for our Ag Law segment this week. So, Roger, thanks for joining us.
Good to be with you, Samantha. My pleasure.
Great to have you, as always. And today you wanted to talk about a case of almost equity theft, I guess we can call it. It's a loss of equity through the government, really, this case that we're talking about?
Yeah, that's right. And what has been teed up for the U.S. Supreme Court is a case out of Minnesota where property taxes on a condominium, for various reasons, did not get paid. And there's a statutory process that every state has by which the state, the county, the city, whatever the governmental entity is, can follow that process. And over a period of time, which includes a redemption period, then the property can be sold to pay the tax lien. That much is clear. That's certainly constitutional. But what happened in the Minnesota case was the homeowner's equity in this condominium above the amount of taxes that had to be paid. Well, after the property was sold, there was a tremendous amount of excess profit that the county made off of this, and they kept the funds. They did not reimburse or remit that back to the homeowner in that instance. So that's the question that's before the Supreme Court. Once the amount of the sale proceeds are applied to the tax bill, isn't the landowner entitled to any excess amount representing the surplus equity that they have in the property? One would think so, but the lower courts, both at the trial court level and on appeal in the Eighth Circuit, said that that was perfectly fine for the state to do. The state has a statute that says they can do that. And so that's before the U.S. Supreme Court right now. Whether that type of law, which 12 states have, is constitutional. It's a big deal.
Absolutely. And of course, this situation we're talking about in Minnesota with this homeowner, of course, more of an urban situation with a condominium. But you're worried about this even applying to instances of farms and ranches?
Yeah, it's exactly the same principle. That just happened to be an urban type set of facts, but the same set of facts could apply in the rural setting. If you've got a farm or a ranch, for example, and there are various circumstances where the property taxes become delinquent, and then the state process gets triggered and the redemption period is extinguished, somebody could end up with a tax certificate and a deed out of this thing, and the tax lien could be paid off, and the county could end up bagging that surplus equity and not remit that back to the farm owner or the ranch land owner in that situation. So the principle is the same. It could easily be applied in a rural setting. And in fact, there are a couple of cases out there where it has applied to a farmer or a rancher.
I guess the difference here, though, of course, that's impactful for this individual in Minnesota. It's sad, of course, there. But it's even more impactful when we think about the amount of equity that, farmers and ranchers have in the land that they own.
Oh, the number one asset for most farmers and ranchers in terms of value in their estate or what they own is clearly, in most instances, the farmland, the ranch land. And over a period of time, that equity builds up. And it can be, in many instances, several $1 million. This is why we worry about the application of the federal estate tax to a farm or a ranch, and particularly if that's going to drop down starting in 2026 to $5 million adjusted for inflation in 2011 dollars. That's a bigger deal than if it's $12.92 million, which it is right now. And indeed, there was a Nebraska case in 2018 where there was a 480-acre farm near North Platte that was worth $1.1 million. and there were $50,000 in delinquent taxes. And what happened was that the landowner was a 94-year-old widow, ended up in a nursing home, and her son had power of attorney. Well, the son delegated his power of attorney, assigned it to a bank for the bank to take care of things. And in the shuffle of all of this, the son assumed that the property taxes were being paid by the bank. The bank didn't know about that because they weren't getting the notices. The owner's in a nursing home, and just by virtue of a mess of circumstances, it slipped through the cracks. It gets $50,000 in delinquent taxes. And before anybody realizes this farm comes up for sale, and it sells for that market value, and the county, well, they lose the farm in that instance for the failure to pay the property taxes. Now, in the wake of that decision, the legislature in Nebraska, the Unicam in Nebraska, changed the requirements for service of notice when you're applying for a tax deed. So hopefully something like this doesn't happen again. And indeed, in Massachusetts, there was an alpaca farm where the small alpaca farmer filed a claim earlier this year, back in January, to argue that the local town unconstitutionally took a $310,000 profit from the sale of his farm to pay a $60,000 property tax debt. And so again, yes, it can happen in a rural setting. The principle's the same, and it has happened in a rural setting.
Terrible, those stories, really sad in a lot of those cases, especially that one with the 94-year-old woman in a facility having to deal with the consequences of that and her son. Stressful, to say the least. And I understand that, Minnesota, this is one of the states, but you mentioned that there's 12 other states that also allow the government to still keep these surplus equity proceeds. What are those 12 other states?
Right. Along with Minnesota, it's Alabama, Arizona, Colorado, Illinois, Maine, Massachusetts, Nebraska, New Jersey, New York, South Dakota, and Oregon. And so this is a problem in those 12 states. Now, fortunately, Kansas has a protection in statutory law where that surplus equity cannot be retained by the county or by the state. So once the tax bill is paid and the property is sold off, at least the equity comes back to the landowner. Now, you still lose the property because of the forfeiture sale. You still have forfeited your property, but at least the surplus equity is not retained by some governmental entity.
Sure, absolutely. So with this case in Nebraska that we talked through, where Nebraska kind of saw this case play out and they're like, we don't really think this is right anymore. Is that kind of what we're hoping happens on, a national scale from the Supreme Court case?
Yeah, this home equity or farm equity theft does tend to bear more heavily, and I think this is going to be the way it's argued. The burden of this type of situation bears more heavily on those that can least afford to hire legal assistance or qualify for legal aid simply because you own a property. You're not going to get legal aid because you are a homeowner, because you own farmland. So even though we don't have many cases on this, that may underrepresent the extent of the problem because these people can't afford to be represented. Now, the other thing I would point out is, and this goes to your question as to what the Supreme Court might do here, every state currently bars a lender from keeping the proceeds of a forfeiture sale, but not every state bars the government or a private company that is not a lender from keeping the surplus equity from a forfeiture sale. That should not be. There should be a consistency between those two. So I'm hopeful that the Supreme Court will see the inequity of this. This is not correct. This is kind of an anomaly that's out there, but it's a big issue, and it's happening as states are hungry and hungrier for revenue. This is likely to be happening more often and probably more than we actually see. But these are some of the prominent cases that are out there. And the Supreme Court agreed to hear this back in January, and we could have a decision this term.
Absolutely. That was my next question. With everything else the Supreme Court has weighing on them in this year's kind of lineup of cases that they're taking through, is if this case is actually going to be spoken about this year, whether or not.
Normally, I would say yes, we would see it this term. However, I would say that because the Supreme Court has been strangely slow in dribbling out opinions this term, maybe not. Maybe we won't get it till fall. But I think in any event, we would get a decision before next year's legislative terms across the country with state legislatures. Because if the U.S. Supreme Court reverses the Eighth Circuit on this, these 12 states have to go in and change their statutes.
Absolutely. Yeah, that was going to be my next question too, Roger. You're just thinking just like I am. So what does that mean if, the Supreme Court does rule in with this homeowner, essentially? What does that mean for those 12 other states going from this point forward?
Well, again, what it means is if they don't change their statutes to conform to what many of us think the Supreme Court will do, then we'll see more cases on this. And the state courts will rule consistent with the U.S. Supreme Court that those statutory procedures are unconstitutional. So it's an interesting issue. It's kind of one of these. There are a number of ag-related cases that are presently before the U.S. Supreme Court. And this is one of these that has an ag relation to it, but is kind of under the radar because it's not a high-profile one like Waters of the United States or California Proposition 12. Those are the big ones that are out there. But this is important nevertheless, and we shall see what the U.S. Supreme Court says about it.
Like you said, this year is kind of an interesting one for the Supreme Court in terms of the amount of cases that are really ag-related, like you mentioned.
As I look back every year at the cases, the prominent cases, when I write my top 10 list every year, it's always amazing to me that there are one or two every year that are Supreme Court decisions. And, I mentioned the Proposition 12 and the WOTUS case. There's also a significant Medicaid case that's out there that will bear on asset protection strategies that we often use for farmers and ranchers. So there's three of them out there, and then you add this one in, and that's a full load for U.S. Supreme Court on the things that in ag we are concerned about. No, they all touch on ag in one way or the other.
Absolutely. Yeah. Well, luckily enough, we are lucky to have you as a contributor to Ag Today programming so you can explain all of these important topics to us in an easy to understand way. So, Roger, as always, thank you so much for joining us.
Thank you, Samantha.
Absolutely. Once again, everyone, that was K-State and Washburn University School of Law professor Roger McEowen joining us for this week's Ag Law segment. We're about to cut to a short break now, but when we return, we'll be back with K-State grain economist Dan O'Brien. Dan joins us today to discuss ethanol outlooks for 2023. He emphasizes the importance of a stable U.S. economy and our nation's ability to travel this summer when it comes to supporting this vital industry to the Midwest. Later on, we'll be rounding out today's show with this week's Beef Cattle Institute's Ask the Experts. This week, our K-State experts Brad White, Dustin Pendell, and Bob Larson answer a listener's question on locking in calf prices now in preparation of selling later this fall. It's a fun conversation you're not going to want to miss out on. Once again, that and more is coming up ahead on Agriculture Today. This is Agriculture Today. You are joining us now for a special Outlook update on ethanol and bioenergy. And to kind of lead that conversation, we are joined by Dan O'Brien. He is our grain economist here at K-State. So, Dan, thanks so much for joining us.
Thanks, Samantha. I appreciate it.
Absolutely. So, Dan, you wanted to do a segment specifically on ethanol outlooks and kind of where the industry currently stands and where we expect it to go price-wise. So let's start with the gist of ethanol. Where do we currently stand in that industry? What does the U.S. economy currently look like in that regard?
Well, overall, I think the USDA supply-demand numbers have remained positive in terms of the amount of corn used for ethanol production. Our perspective is unique. Again, we're representing both the industry in terms of ethanol plants, but also corn producers, corn and grain sorghum producers. But so often we're kind of focused on how it affects things at the farm gate. And when you look at the actual bids that are happening out in the country, in Kansas, we have corn bids at ethanol plants averaging about $6.90. And that's the highest in the nation. We have a top end bid of over $7 at 704.25. This is as of March 8th, and then a 667. So 667, 704 range. And again, that beats the Corn Belt. Nebraska's pretty near that. They have the same top end bid, but a lower bottom end bid. So out here in the Western Corn Belt, we've got some things happening. I think that when we're looking at ethanol, we go, I start with the U.S. corn supply-demand balance sheet and look at how many bushels are projected to be used for ethanol, and to see if in the USDA's recent supply-demand balance sheets that they put out in the WASDE report, if they made any changes. You do see last year, for the marketing year of 2021 and 22, which ended August 31st of 2022, we had used about 5.326 billion bushels of corn. For this marketing year, the one started the day after that, September 1, and will run through August 31st, 2023, projected at 5.250. And that number in general has been thought to be at a bit of risk. If the U.S. economy were to go into a major recession and what use of motor fuels dropped off, then we could see that lower. But so far it hasn't happened. And I guess what's a surprise to me, Samantha, we're sitting here in March, and I think according to the calendar, we're still in winter, but I understand at least through this month. But summer driving season is just out in front of us. And generally, as long as the economy holds up and people want to get out and travel, which they've shown every tendency to do, it would seem that we would hold up pretty decently. I guess we watch things like the amount of corn ethanol stocks, ethanol production stocks, and they're holding steady at slightly higher, but not at terribly burdensome levels. So that's a positive sign. And I guess what I'm trying to say is that you look at the motor fuel market overall, we certainly have seen some major highs. I know here out in parts of Kansas where I live at, we're down to gasoline prices of around $3, $3.10, $3.20, some below that to $2.90. It just depends where you're at, driving along I-70 and in these rural communities. And that's down about $1 or so or more from where we were at the highs a bit ago. So
last summer, right? So that's what you're referencing, kind of the summer highs we saw? That's
right. The seasonality of people wanting to, quote, get out, which they did. So that's in front of us yet in the ethanol market. I do hear quite a bit of discussion about E15, some recent ag media articles analyzing that, and real great optimism on the part of the industry to see that come forth. So that's, to the degree E15's all that much more readily accepted across the country in engines by consumers, well, that's all for the good. I would say that lower corn prices have helped on the profitability some. And standing back and looking at ethanol price, cost, profit loss estimates running through the first week in March, latest data we could get. It looks like at the plants, and these are ISU plants, they're taking into account ethanol sales, DDG sales, and also now looking at corn oil sales. And that in the past we weren't always accounting for, but now that's another source of revenue in those plants. So the ethanol price for the week ending March the 3rd was $2.06. The cost of production was $2.11 for a loss of about 5 cents. And that you'd think, oh gosh, that's terrible. Well, there have been times when we've lost 19, 20 or so in the not too distant past. I think in February we had lost 17 cents. So if anything, we're starting to trend a little bit to the positive side. Last summer, towards the end of last summer, we got up to $3.12. Well, that was tied in with all those price run-ups that we had seen in the gasoline markets. Had great profitability of $1.06 a gallon at those ethanol plants. But again, now they're down to, I guess as how it happens so often in the ag markets, if we're making ag and energy markets, if we're making money on something, we'll just wait around because we tend to take all sorts of actions, which lead us to losing money. We overproduce and all sorts of things. So the point is now from those highs back in 21 where we got up to $1.06 and last summer 22 over. Well, now we're back down to break even, just about a break even situation.
Dan, let me ask you a quick question too, because you're mentioning overall prices right now that we're seeing, the averages, but you mentioned earlier Kansas, we're seeing pretty high prices compared to the rest of the country. So why Kansas specifically?
Well, I think Kansas ethanol plants are willing to pay a higher amount for corn. I think it's out of necessity in the Western Corn Belt. That comes back to that overall corn supply demand issue that you and I have talked about quite a bit. In that, that short crop last year forced ethanol plants to pay a high amount in Western Kansas to get hold of the short supplies of corn. And as you pointed out, we're 30, 40, 50 cents higher for the corn price going into ethanol plants and here in Kansas and otherwise. And I just think there's more abundant supplies in the central and western part of the U.S. I'd want to add one note, though. There's a weather forecast that came out here recently talking about how if current weather patterns keep going in the direction they're going and they unfold, then the dry area of the country would be more the central part of the U.S. and less so out where we're at. Of course, nobody in Western Kansas is begrudging that dry conditions to anybody. But the point is that higher prices of corn, higher prices of ethanol brought on by dry conditions, Central Corn Belt could have some really interesting dynamics for the ethanol industry out in Western Kansas and the Western Great Plains, as perhaps we might be in a little better position to produce profitably. And one of the issues we have out here in the West is that we're in a position geographically to ship ethanol and other biofuels to the West Coast. And they have a unique market market as they're set up. So I guess it's going to be exciting to see all this unfold. And hopefully we have abundant grain this year, decent prices and abundant grain. And that in terms of an ethanol plant point of view from Kansas, that'll lead to profitability in our neck of the woods.
Absolutely. Ethanol markets are something I'm a little unfamiliar with. So in terms of how fast these markets tend to catch up with the prices that we're seeing with, good crops and things of that nature with our normal markets, how far does ethanol kind of lag behind in that regard of playing catch up?
Well, ethanol operates on the margin. In a way, it's almost like cattle industry. There's some parallel in that, yes, we have the ag production aspect of this in terms of the beef industry, again, how many cows we have, et cetera. We have the number of plants that we're considering for ethanol. And there's in general, a hope for steady demand. Well, you get policy initiatives come into play. And that's probably where the beef industry and the ethanol industry part ways, in that there's so much more of a EPA involvement in actually determining how much of ethanol is blended into fuels, and that in itself having an impact on the prices and profitability and just supply demand balances coming in. So if you're asking me where the ethanol industry might be going, it seems as long as we have good economic forces happening in the U.S., motor fuel holds up, and we don't come in and do any drastic redo of our ethanol policies, then we're still blending around 10% of most motor fuels used in the country with ethanol, and that's such what I'd call as an economist, a very inelastic demand, i.e. we have to blend 10%. And if that's the case, then that drives so much of what's going on. So if you're in the ethanol industry, you're watching what the Fed does. You're watching what the economy's doing, because that determines how many vehicles are on the road for how long and how much ethanol they use.
Absolutely. So when we consider net returns that we can expect for this industry this year, what does that kind of look like for 2023?
I think that probably we'll see an increase in net returns into the summer of this year. And I'm basing that on the idea that we'll have a successful corn crop, that will have good corn prices, but not extremely high corn prices. In that scenario, we have moderately priced corn, hopefully lots of bushels of it. So the farmers are making money, as well as the ethanol plants buying the corn at a reasonable price. And if we can avoid economic downturn in the U.S., we'll still have consumers driving vehicles a lot in the summer, we hope. So as you're looking forward out into where we could be going, it would seem that we're probably set up for moderate profitability, not 50, 60 cents or $1 per gallon produced, but more like 5, 10, 15, 20. And where that scenario of 15 to 20 cents per gallon profit could fall apart would be as if we do get a drought, corn price shoots way up, or on the demand side for ethanol, again, we have an economic downturn and people just can't travel as much. So we're optimistic right now with regard to ethanol that we'll have moderate priced corn, strong seasonal ethanol markets. And with that, we'll be able to make a decent profit that will keep the plants running. And we'll see where that goes in 2023.
Dan, well, thank you so much for this outlook on ethanol specifically, a big industry like you mentioned here in Kansas specifically. So great news in terms of hopefully where this industry will go in 2023. But thank you so much for this update.
Thanks, Samantha. I appreciate it.
Absolutely. Once again, everyone, that was K-State grain economist Dan O'Brien joining us for a conversation on ethanol outlooks for 2023. We'll be back with more ahead on Agriculture Today. You're tuned back into Agriculture Today. We're concluding today's programming with this week's Beef Cattle Institute's Ask the Experts. This week, K-State experts Brad White, Dustin Pendell, and Bob Larson answer one of our listeners' questions.
Hi, welcome to Beef Cattle Institute's Ask the Experts, where our experts will answer your questions. I'm happy to have two experts with me today, Dr. Dustin Pendell
Brad.
And Dr. Bob Larson.
Good morning.
So we're happy to have your questions. We've got a great one today, but if you ever want to send us a question, you can send us at bci@ksu.edu. And as the experts answer your question, they each get a score of up to 10 points. Today's question comes from a listener and thinking about calves that are just coming on the ground now and asked the question, should I lock in the price of those calves for when I'm planning to sell them at weaning in the fall? Dustin? Dustin, I'm going to go to you first.
That's a great question. And, I'm assuming the listener is tracking their prices or tracking all their costs so they know what their kind of break even is. And so coming back to the question, should I lock in the price for my calves this fall? I'm going to say yes. And the reason is I'm a little more risk adverse. I want to make sure I can lock in that price against prices might go for me and I might lose some potential, but I'm risk adverse. I want to make sure I lock in. I can guarantee I can pay the bills.
So if you've got a good price today, you're saying
if I know what my break even is, I know what the price is, I'm going to lock it in if I am making some money.
Excellent. So 5 points for Dustin out of the gate. Bob?
I took some ag econ classes, so I'm going to say yes because of the ability to do some risk management, because I only took a couple of ag econ classes. So then I'll just say, but I don't know exactly how. I do understand I need to know my cost structure, so I know if I can at least lock in to cover my cost, and then maybe not for all my calves, just some of my calves. So I'm going to say yes, I want to develop the ability and the contacts that can help me make this decision so that at least that's an option for me. But I don't know exactly who to talk to. I don't know exactly what my options are. So I'm going to turn mine into a question for Dustin and say, so who do I talk to and what are my options?
2 ag econ classes, and you've watched Trading Places several times.
Exactly. So that's what I know.
I'm going to give you 4 points for that.
I think he brings up a good point. And the reason I said yes, I would lock in, it is a risk management tool, right? You can forward contracts, you can hedge in the futures market, et cetera. And so there are various ways to do that to try to reduce that price risk. And you talked about maybe not locking in all the prices because prices do go up. You might be able to capture a little bit. That is one strategy. Everybody's got their own different strategies, probably based on their risk tolerance levels. Coming back to your question, who would I talk to? Of course, you've got your team of experts, right? Hopefully your veterinarian, your lender, et cetera. And then hopefully you've also got a broker in there that might be able to help out as well.
Yeah, absolutely. And so Dustin, up to 8 points. And Bob, I'm going to turn it back to you because you're not alone. You're saying, I don't have a lot of knowledge in this area. I've got to go figure out. So how are you going to figure out how to make this decision?
I like what Dustin said. I'm going to use my experts because I need to talk to somebody about what my options are. Because in my opinion, it appears to me that crop farmers use hedging a lot more than cow-calf, and feedlot and stockers might also. So as a cow-calf producer, it's just not something that we commonly do, or at least it doesn't appear to me. And so I'm going to need some help. At least at this beginning stage, I'm not comfortable making that decision myself. Maybe with more practice and more skills, I'll take more of that responsibility on myself. So I want to find somebody locally that I can help.
Yeah, find somebody you can have a conversation with. Now, Dustin, I'm going to turn back to you and say, Bob talks about feedlots or other areas of the industry that commonly use risk management. Cow-calf doesn't, and cow-calf only sells once a year. Do I need risk management more or less than somebody who's selling all the time?
Well, if you're selling all the time, you're hitting the highs, but you're also hitting the lows, where if you're selling it once a year, if you just happen to be at the low point, I think that could be a bigger downside risk. So I would say you probably would for sure want to if you're only doing it once a year.
Yeah, that becomes the issue on the cow-calf side is you may only sell it once a year.
Right.
So right now we're tied up. So toss-up question. You guys both said yes. What tool would you use? And Bob, you said you might go with an expert, but what tool might you use to protect the risk on these calves?
Oh, I might say something dumb, but it depends on what my goal is. I've known producers that use kind of an out-of-the-money put just to put a real low floor on their cattle. So I think that's a relatively inexpensive way to begin thinking about it. But yeah, any kind of a forward contract.
Dustin?
That's, the futures market's forward contract, or you might try to, if you can work directly with the feed yard, would be another option that you might think about too.
Absolutely. 2 good options. I'm going to give it to Dustin on that one. Thanks for joining us today. And if you have questions, send us an email at bci@ksu.edu.
Once again, those were K-State experts Brad White, Dustin Pendell, and Bob Larson, ending today's show with this week's Beef Cattle Institute's Ask the Experts. We'll be back with more tomorrow on Agriculture Today.